the lie and the smoke and mirrors that they tell us for our entire careers. And then all of a sudden, you get to the end of the road of your career in order to then retire, and you can't because you listen to bad financial advice from people who just made commissions on what they told you to invest in for 40 years.
Hi, I'm Tim Bratz, and every week I sit down with the top influential entrepreneurs in the country to discuss how to leave a true legacy in all things happiness, health, wealth, and wisdom. This is the Legacy Podcast.
Hey guys, Tim Bratz here. Welcome to the Legacy Podcast. Today I'm sitting down with my buddy Chris Miles. Chris and I are part of a couple different masterminds together. He was recently on our podcast talking about a lot of things money related, personal finance related. He is a cash flow expert known as the anti-financial advisor, has helped a lot of high income earners break free from the grind and achieve financial freedom. So, and most importantly, without Wall Street, right? Doing it in a non-traditional ways that is a better way, a cleaner way, simpler to understand kind of a way. He retired twice before he was 40 years old. He's a founder of Money Ripples, a great podcast that I've had the pleasure of being on. Author of Work Optional Blueprint, which was recently released, and obviously host of the Money Ripples podcast. So he's helped his clients create over $300 million in cash flow and passive income over his career, and doing some amazing things, like talking about the money ripple effect. So, Matt, great to have you back.
Man, it's glad. I'm happy to be here, man. It's great to be here.
Well, last time you were here, we had kind of like closed out and talked towards the tail end, or it might have even been after the podcast, about a lot of the infinite banking concepts. And this is something I've never talked about on my podcast, and having this for 4 or 5 years now, 5 or 6 years. And I want to dive into it. I think there's a lot of understandings, misunderstandings, myths, conceptions, positive outlook, negative outlook on whole life, universal life policies, question marks around infinite banking and exactly what that is. And I'd like to dedicate a lot of this episode to that. So maybe you can start out with kind of briefly explaining how you became known as the anti-financial advisor. And then what I'd like to do is dive into the infinite banking, especially for real estate investors.
Yeah, I became the anti-financial advisor because I was the financial advisor, right? I was the guy that was a salesman in a suit trying to tell you to set it, forget it, put your money away in mutual funds forever and that kind of thing. 4 years into that career, my dad asked to sit down with me and understand that my dad was like the penny pinching saver, depression, post-depression era mentality. I mean, everything was you buy on sale, you pay off your debt, it's evil. He's like Dave Ramsey's dream come true, right? Well, when I sat down with my dad to look at his numbers, he says, Chris, I'm 61 years old. I've had strokes, heart attacks. I think the stress from this job will literally kill me. I want out. So what do I do? And I looked at his numbers. I saw he put in his 401k, got the match, and he even like paid off all of his debt, including his house, so 100% debt free. I mean, like every good boy and girl should, right? And then I had to tell him, I said, Dad, if you try to retire today, you're going to run out of money in about 5 or 6 years, meaning you pretty much have to die in 5 or 6 years, at this point. He's like, okay, great. Thank you. What do I do with this? I don't know. You did everything right. And that's what really bothered me because
let's put right in quotes, right?
Yeah, right.
That's what the traditional world, the lie and the smoke and mirrors that they tell us for our entire careers. And then all of a sudden you get to the end of the road of your career in order to then retire, and you can't because you listen to bad financial advice from people who just made commissions on what they told you to invest in for 40 years. So That is the right thing to do, right?
You got to set it, forget it, scrimp and save and put it away for someday. And hopefully you have something, right? And he just didn't have enough to really last a lifetime, so to speak. And I found out that that's the majority of Americans that are following the advice to a T. They're following Dave Ramsey and Susie Orman, all these guys to a T, and it's just not enough for the vast majority of Americans. Not that they don't make enough money, not that they don't save enough. It's just not enough. You have to save an obscene amount of money to make up for this, for the bad performance in the markets and things like that. And so, long story short, a month later, I'm talking with a friend of mine who I trained to be a financial advisor, but then he quit to go do real estate investing, specifically fix and flips. Right? Actually, he wouldn't even fix them. He would just flip them. Because in 2005, 2006, you didn't even have to fix anything up. You just hold on to it a couple months, sell it, you make money from the appreciation, right? And so he was doing that, and he finally just cornered me. And he just said, Chris, well, tell me, how many of your clients are truly financially free where they don't worry about money? Well, none. They all worry about money. Even the retired ones still worry about running out of money too soon. Okay. How about this? How many of you guys as financial advisors, and you were kind of saying this, Tim, how many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these same investments? And right there, he got me. I'm like, I don't know. There's guys working here since the 1970s and they don't seem like they can quit. So none. There's your problem. And that's when I started to wake up. I took the Matrix Red Pill of real estate and started to see that there's this whole other world that's not about accumulating money and setting it and forget it for 5 billion years, right? Hope that it compounds enough interest because the eighth wonder of the world, as they'd like to claim. And no, like instead, create cash flow now. How do we create actual passive income? How do we get that income coming in? That's where true freedom is. And so for me, later that next year, 2006, I started doing some of the same stuff, turned my starter into a rental. I cashed out all the equity when I did it too. I also did some things with lending and whatnot. And next thing I know, I have enough money to be retired. I had enough passive income coming in. I didn't have to keep working anymore. And of course I had already left financial advising by that point. And so that's kind of my story. And I came out of retirement in 2007, teach people how I do what I do. Now, to tie in with infinite banking, when I was learning about real estate and stuff, I started hearing these real estate investors, even back then in 2006, saying, oh, you should do this infinite banking. It's so cool. And I'm like, well, what's this infinite banking? I was a financial advisor. I've never heard of this. And pretty soon they started telling me, they're like, yeah, it's using whole life insurance. I'm like, whoa, hold on. Whole life insurance? That's the worst thing. Like that's the thing I told everybody to not buy. I don't know why exactly, but that's what other financial advisors told me to say. In fact, if I recommend anything, it would be universal life is kind of more what I would maybe promote if we were doing that kind of strategy. And but I started.
What's the difference between whole life and universal life?
There's a big one. So that's what I didn't understand either. So whole life insurance is interesting because the cost. Here's the negative that people will say about whole life. They'll say it's quote unquote expensive, right? They'll say, yeah, it's so expensive, especially up front because it is front loaded with costs, but then gets cheaper over time. But universal life is basically buy term invest the difference. Universal life starts out cheaper as you're younger, but gets more expensive every single year. So the costs actually go up every single year. So that's one key difference right there is that the costs can be worse in universal life.
Now, when you say cost, are you saying cost out of pocket expense to get the policy and have the policy is more expensive? Or are you saying almost like
insurance costs,
like depreciation or not depreciation, like amortization, right? On amortization, when you buy a house, majority of it goes towards interest initially, and then you get more and more principal contribution later. That's my understanding of how a lot of the whole life and universal life policies work, right? You put in $50,000 in the first year, the face value of the policy is only like $5,000. All right, well, where's the other $45,000? Well, it got paid out to commissions and all these things. And so you have to put 50 grand a year in every single year in order to hopefully by year 10, you put $500,000 in and it's grown to $500,000. And you're like, what happened to all this money over the course of the past 10 years? If I would have put it in real estate, I would have gotten better returns on it. And I would have made 10% per year or 12% or 15% per year on the 50 grand. That would have compounded in year 2 and 3 and and so I would have been way further ahead if I would have put my money into real estate.
Yeah.
Is that not the case? Am I misunderstanding this?
No, that's exactly how I think too. Especially if it's designed the way that most will design them, right? Now there is a difference between whole life and universal life. Universal life is a lot like renting, where whole life is like buying. Because like what you just said, I like that example of like when you buy a home and it's amortized with the mortgage, you pay more towards principal, and that's just the math, right? You pay more towards, not principal, to interest in the beginning, and then it gets better over time. You start paying more and more to principal. That's true with like whole life insurance, but it's quicker. You get to paying your own principal very quickly. Mm-hmm. Universal life is the opposite. Universal life is more like renting. It's actually cheaper insurance costs. When I say the costs, the underlying costs are the insurance costs, which is where the agent's commissions come from, right? And so the costs actually start cheaper up front in universal life and then get more expensive over time. That's one of the big things that most people don't realize, that it actually gets worse over time. And if it doesn't perform perfectly, like the way they like to fluff their numbers, then all of a sudden you start realizing that it starts eating itself. The cash inside of it starts eating itself alive. And I would see that a lot. Even when I was a fan of universal life, I was training new agents.
So explain that to me. So if I'm putting in $50,000 a year, Are you saying it goes up to 55 or 60 or $70,000 in the future? Or are you saying of the $50,000 of contributions, that is then getting it's heavier on principal or face value initially, and then it kind of gets diluted, and it's fewer and fewer dollars that end up going toward face value and principal contribution. Is that the case?
Yeah, it's the costs are getting more and more expensive. So if you're putting in a certain amount of money, right? Like there'll be a cost, insurance costs be pulled out. But as time goes on, those insurance costs creep up on you because every year you're alive, that you're older, right?
So it's not like locking
in
in your mortality rate earlier on when you buy the policy. It adjusts every single year.
Yeah, exactly. That's universal life. Whole life is different. It's more like what you just said earlier, which is it locks in. It is front loaded with the costs and then gets cheaper over time, right?
Yep.
So that was one thing with universal life. Like as long as I ran great numbers, and there's also different types of universal life. There's the boring universal life that nobody really buys anymore, right? Unless you're old. There's the indexed universal life that's becoming popular, and people are trying to say that that's infinite banking, which is not. I'll explain why in a second. And that one is actually tied to an index like the S&P 500. But if the S&P 500 goes down, they'll at least have a floor, right? So I'll have a floor of like 0 or 1% that it won't go below that. So if it goes, market tanks like say 30% next year, at least you get 0 or 1%. But if the market skyrockets at 20%, you might be capped at 8, 9, or 10%, right? And then if it goes to 5%, you get 5% and so on. So it has a floor and a ceiling. It's almost like having a salary job, right? You're not going to get a big raise, but at least you're not going to, not have no money because you're earning commission only, right? It's got a floor and a ceiling. The problem is this, is that those floors and ceilings, they can adjust at any time. When I used to sell universal life back in the early 2000s, we saw ceilings at like 17%, 12%, things like that. And then the floor would be like somewhere between 1 and 2%. Now they've lowered it to where the floor is like 0 to 1%, and then it might be a ceiling of 8 to 10%, which means you get less of the gains when the market goes up. And the problem is this. So imagine this, right? So you put in your premium. Let's use your $50,000 a year, right? You're putting that $50,000 a year premium in. Now you put that $50,000 in, fine, like insurance costs come out. But what if the market goes down? And let's say it goes down for 2 years in a row. Now you're earning 0 or 1% on that $50,000 for those next couple of years. But what if the insurance costs are $2,000, right? So yeah, you might have made $500, let's just say, but then you lost $2,000 each of those years. And maybe it was even more because it went up, the insurance premium went up a little bit more, right? So now you're finding yourself in the hole. You're like, dang, I put in 50,000 both these years, but now like my cash is not 100,000. Now it's actually gone down, right? That's the part that they don't ever illustrate for you because they always just show that it's going to go straight up at like the 6 or 7% rate, but that's just not reality. Most of them will overpromise and underdeliver in my experience. I had one, and so that's one of the things with universal life. Here's the other problem too. In those early years, and this is where you kind of mentioned like it gets better over time. Well, that's only because they have what's called a surrender fee, which means because they don't want you accessing cash early, they're going to put this massive kind of thing they call a surrender fee. It just means that you can't touch the cash. So there's cash in there, but they'll say this is locked up, right? It's almost like a bank saying, sorry, we're going to lock up your line of credit. You can't get to it. So that's one other thing that's also limiting with the index universal life. The other thing is also this, is when you do try to borrow, what's interesting is that banks don't like to borrow or loan you money based on your universal life policy. They'll do it, but they might only do up to maybe 50%. Why? Because they know there's risk that you could actually still lose money in those. All right. So that's one thing with universal life. And we'll get back to what infinite banking actually is, right? But that's just the difference between those two insurance things, right? And whole life insurance is different. Whole life insurance, because it's guaranteed, there's always a floor of at least 3 or 4%, depending on your policy. But they pay very steady. They're not tied to stock markets. They're not tied to any kind of ups and downs or Bitcoin. Although there's some people trying to tie it to Bitcoin, as a fun little thing, which I think is a mistake. But right now they're paying like 6% a year tax-free. Right? That's very boring. They pay like, even on the low end, they were paying like in the mid 5s, and now the interest.
And when you say they pay it back into the policy.
Correct. Yeah. So that's what the interest you actually earn on the cash that's in the policy, right? That's one.
And these are after tax dollars that have bought the policy. and
Yeah.
contributed in premiums to the policy, but you're saying it grows tax-free as the interest comes in, it grows tax-free.
Think of it like a Roth IRA in a way, but it has the same taxation as Roth IRA, but you don't have to worry about the 59.5 rule and penalties and things like that. So same thing, you put it with after-tax dollars, grows tax-free, comes out tax-free. And this is true of all life insurance, like that, other than term, right? All life insurance does this. You put in with after-tax dollars, grows tax-free, comes out tax-free. Even the death benefit is also to your family tax-free, right?
What about term life?
Term life is just a death benefit. So there's no cash building, no cash
Right.
account, right? Well, that's the difference with whole life and these other, permanent life insurance is that they have the death benefit, but you also have this tax-free savings account. It's really like a tax-free high yield savings account that you got.
But in term, the payout on a term life insurance policy is not taxed either, correct?
Correct. That's correct. Yep. Same tax rules on the death side. Yep.
Yep.
So that's where, whole life, and here's the problem with whole life, right? I'll get into the ugly about whole life too, is because I was talking about whole life being this infinite banking. And here's what infinite banking is a strategy. It just means that you're moving money in and out. You could probably do it with a savings account too. It just doesn't do as well, right? Because savings accounts pay you 0.0%, and then you get taxed on that 0.0%. It's also not protected from lawsuits of creditors, where life insurance is 100% protected from lawsuits of creditors in most states. Sorry, California, you suck. But they've got some protection, but not unlimited protection. But I can literally, in my state and most states across the country, have millions of dollars in my life insurance. And if somebody sues me and wins, this is the only place I can store it other than a 401k where they can't get to it. So you put your money in a savings account, they'll get to it. You put in CDs, they'll get to it, right? You put in IRAs, they can still get to it. I mean, you can put it almost anywhere and they'll get to it if somebody sues you and wins. Not true with life insurance. Here's another bonus that I don't often say. When it comes to college savings, right? When people have kids that are saving for college, or if they don't go to college, the one thing is this does not count as an asset against your kids' financial aid. So if you're trying to qualify your kids to get a scholarship or financial aid, even in my case, some of my kids were able to get some limited scholarships from the colleges they went to because the life insurance does not count as an asset. But when I try to get loans from the banks, it counts as an asset. It counts as emergency cash reserves, just like a savings account would. So it counts when you want it to count, but it doesn't count when you don't want it to count, right? So you protect from lawsuit creditors. It doesn't count as an asset when you're trying to get financial aid and things like that, but it counts as an asset when you're trying to get secured loans from banks.
This episode of the Legacy Podcast is brought to you by
Legacy Family Mastermind. I know what you're going through. I know you feel stuck in small deals, trying to figure out how do you get to that next level. I know it's hard to raise private money for real estate deals the way that the economy's been over the past few years. There are probably properties in your portfolio right now that are either losing money or at best break even, and you're trying to figure out how to turn them into winners. Or you're thinking to yourself, dude, I just want to be able to go on vacation without my business all being on my shoulders. Not having the time freedom or the financial freedom that you thought real estate was going to give you, I see it over and over and over again. But I've got the solution to every single one of those. Legacy Family Mastermind. This is a group of high-level commercial real estate investors that can help you break through every single one of those bottlenecks and help you get to that next level. I mean, you know the saying that when the student is ready, the teacher appears. Here we are. If you are serious about scaling your rental portfolio, we are here for you. This is the group to do it with. We would love to help you on that journey and design the exact life that you want to design so that way you can live it to the fullest. The next step is simple. Just schedule a call with my team at the link below and we'll see if it's a fit, because I want to see you sitting at the table with our Legacy family. Let's go build some wealth together. You said IRAs are not exempt from creditors either?
Correct. Yes.
I didn't realize that. I thought because it was a retirement account, it was exempt from creditors.
Yeah, not the IRA. The 401k has that protection, yes, but the IRA does not, including Roth IRAs. So they can put a lien against those things or just have them make you cash them out, right? Just like you have a lien against your mortgage, or against your house, I should say, not your mortgage. So you can do that too. But yeah, this is one of the few places, unless it's a 401k, you can do that. But I don't use the 401k. I think the 401k is a piece of crap, especially for business owners, because why would in my best tax bracket, one, because of Trump tax plan, two, because I'm a business owner, I've got the best tax advantages right now possible, right? Why would I defer my taxes to a later date when I may not have all those tax advantages, including my kids, mortgage interest, and everything else I can be writing off, and my business? Why would I
And you'll be in
defer
a
it?
higher tax bracket. And by the way, we're $40 trillion in debt. So where do you think that money's going to come from? It's going to eventually
Bingo.
increase the tax bracket in the future. I'd much rather pay taxes today and then not have taxes in the future because I'll probably be making more money. And I assume the tax brackets are going to go up. So much better
Exactly.
to be in a Roth component.
Totally.
But that
The Roth rules could also change, right?
yeah, and they're
That's the
talking about it.
problem.
They've been talking about it for a while now.
Yeah, that's the thing. The government can change the rules on qualified plans, IRAs, 401ks, Roth IRAs, SEP IRAs, you name it, right? They can change the rules at any time, and you have no say in the matter. But life insurance is a contract. Whatever the tax rules are at that time, it's locked in, it's grandfathered in. So that's one other advantage why I trust using my life insurance instead of like a 401k. But here's the other thing. Here's the thing I was getting to about my original policy that I bought, because I bought that whole life policy. I didn't know how to set up myself. So I went to a guy that they all recommended, all these real estate investors. And when I saw the numbers, remember, I had an insurance background too. I was a securities license guy. I sold mutual funds and I sold insurance, including universal life. And when he showed me the numbers, I saw the first 2 years. And just to use your example, if I'm paying him, they say 50,000 a year, I was paying him, 12,000 a year at this point. But all that money, the first 2 years, was going to pay costs. And I told him, I said, man, this is kind of expensive. Like I'm used to having at least a little bit of cash day one. Are there levers we can pull to make this better? And the agent told me no. He says, no, if you do that, you'll get taxed. And I was like, well, I hate taxes, so let's not do that. And so I bought the policy, just took his word for it. Well, 2 years later, we're going to 2008. This is the point where my real estate's suffering. The business we started in 2007 was suffering because all of our audience, our avatar, we're basically real estate flippers. So they're going broke. As a result, our company's going broke. I'm in the hole in the company. I'm in the hole in my own personal finances. So I'm in the hole like 15,000, 16,000 a month. I cannot afford to pay my $1,000 a month premium. And so I called the insurance company. I said, hey, is there anything we can do? I've had this now for over 2 years. They say, no, you have no cash in here. So if you don't pay the premium, you lose it. I had paid in 25 grand into that policy over those 2+ years, and I had nothing to show for it. I lost that policy. Just probably like 5-6 months later, I'm starting to research into it, and I realized the insurance agent had lied to me that I could have pulled different levers. So because I still held my insurance license, my life insurance license, I went and did my own numbers, did my own research. I went to companies that said, hey, what can I do? Can I make this better? Found out there was ways I could actually lower the required premium, because that was the thing. My required premium was the amount that they set. And it's like, can I lower this more? I'm like, yes, you can. You can do this and this. And the next thing I know, I'm like, I could have cash in here from day one. So I confronted that insurance agent. I went into our office, I shut the door, and pretty much had a debate with him, almost yelling at him for 2 straight hours. And he was trying to come back and say, well, you should have a higher death benefit and this and this. And I was like, and finally I got down to it. I knocked down all of his objections. Like, look, what I'm doing here, they would have more cash from day one. I would have been able to keep my policy because I wouldn't have to pay such a high premium. My cash would be able to pay for itself at this point. I wouldn't have had to get rid of this thing. I wouldn't have lost so much money. And he just told me, he said, Chris, I did it that way because I couldn't afford to cut my commissions. And this is the problem I've seen over the years. Even when I would find a guy that would do it for me, because and I'd sent dozens of clients to him, by the way, including family and friends. I was like, dude, I'll never send you a referral again. I found somebody else to do it for me. And just years later, what did I find out? When I started doing my own research, I started to question what he was doing and found out it could have been done better. And so in 2017, I finally brought it in-house because I got so pissed off that it's like anytime I would use an insurance agent, they would always go to what would, it still would be a little bit of a win for the client, but they would still take a little extra commissions for themselves by raising those insurance costs, right? And so I just said, screw that. I want to do it the way that an investor wants to do it. Like you were just saying, Tim, it's like, I want to do it in a way where this thing doesn't really have much of a net cost, if at all. And so that's what I did. Now I got it to the point where instead of 100% of your money going to commissions and insurance costs in the first 2 years, now it's like 85 to 90% goes to you, only 10 to 15% is going to the insurance company, right? On top of that, what's kind of cool too is that the minimum premiums, there's flexibility, right? So almost like the universal life, like people say, well, it's got flexible premiums. I can do the same thing with whole life, but have less risk and even beat the universal life policies. and you have access from day one. So like year one's the most expensive year in whole life, right? That's the one that they all rip on, even Dave Ramsey, right? And year one, like usually only about 20% comes out in cost. That's about as low as I can get it while still keeping it tax free. So if you put in, say, 50,000, you'll have 40,000 from day one. In fact, I had a guy that owns a real estate turnkey company, one of our mutual friends actually, and he was paying in like $6,500 a year into a policy that I told him it was crap, but he still did it anyways because the guy sent him referrals. Well, 6 years later, he says, Chris, I've paid in like 37 grand in this policy and I only have 18,000 in here. And I said, well, watch this. And I showed him the same thing and said, well, look, you have almost all your cash in year one, like just 20% or so comes out in year one. And by year three, it's paying for itself. And he's like, well, dang, if it's gonna be that good, I'll do 50,000 a year because now I'll have 40,000 from day one that I can access whenever I want. It's cash savings available to me. By year three, if it's paying for itself, by year five, it already has more than what I've paid in. Now it's great. Now, from an investor perspective, here's how I would fund it and how I have been funding it is the first 2 or 3 years where there's a net cost, use your emergency fund for that. Your emergency savings that you have that you're never going to invest with anyways, that you're using for your family and whatnot, or for your business, use that money to go into the policy first when there's a net cost. By the time you're actually using the money you might be using to invest, by year three, if it's already paying for itself, you put that money in, you can pull it right back out and invest it. And this is where the magic of infinite banking happens. And there's a myth and there's reality. And the interesting thing is the reality is actually better than the myth, right? The myth or the lie is people will say, you can access the money 2 ways. You either withdraw the money like you would a savings account, but if you withdraw money, obviously now the money's not earning any more interest inside of there, right? Now it's going to be in that investment, that one place. Or the other way is you can get a line of credit against your policy that's being used, the cash, not the death benefit, but the cash that's there, use that as collateral. And either the insurance company or the bank, there are certain banks that will do this too, will give you a line of credit against that money. It's usually a 95% line of credit. So if you have 100,000 in there, they'll give you $95,000 line of credit. You can use however you want. You don't even have to ask for permission. Doesn't even go against your credit score. There's no credit report run. You don't have to have any credit because it gets guaranteed. They don't worry about that because it's always going to grow in a whole life policy, that is. So for that reason, also they don't require monthly payments. So you can pay back these loans however, whenever you want. The deadline for paying back these loans is your death. Now, here's the thing. The lie people will say is you pay yourself back interest, right? They'll say that kind of thing. And even some of our friends in the infinite banking space will say this. 100% lie. You do not pay yourself back interest. You are literally getting a loan, a line of credit from either the insurance company or the bank. You're paying them interest. But here's where it's better than what they're saying. Because the money that's there, your money's still all there, right? So that $100,000 is still there earning tax-free compounding interest of like around, say, 6%. Now, they're also loaning you your money at, say, around 6%. So almost the same rate. So even if you don't pay back, I mean, granted, you're not going to make any money. This is going to be like a race of compounding interest. Your interest in your loan, if you're not paying back, does compound against you if you never pay towards it. Same thing, but your policy is also going up too. So they're going up like this, right? But here's where the magic happens is what if you use that for investment and or in your business, which by the way, you get to write off the interest if you use it in your business, right? So let's say you do that and you take the returns from that investment and pay it back towards the line of credit. This is what some people talk about with velocity banking, using your mortgage, your home equity line of credit, your HELOC, right? They'll say, hey, use that to invest and then take the cash flow and pay it back towards the HELOC, and you'll save interest, right? Well, here, this is like a HELOC that pays you interest, tax-free interest, right? So if you do it this way, where you start taking the returns from that investment to pay back towards your line of credit, the loan balance goes down. Therefore, the interest you get charged goes down, but the interest they're paying you compounds and goes like this. So you actually get a spread. You start making more in interest from the insurance company than what you're paying them in interest. So you make money, net profit there, and you're still making money from your investment too. So instead of using these life insurance as like this long-term retirement savings plan, which yeah, it could be a tax-free retirement savings down the road, I use this money as one, a great place to store my emergency fund where I'm going to make more than 0.nothing% and not have to pay taxes on it, a lot more, especially when I'm making 6% tax-free. And then two, for the remainder above and beyond what I want to hold in reserves for myself, for my family, and for my business, The remainder of that can be used to make money in two places at the same time, where I'm earning interest in my policy while also investing and making money outside of it too.
Interesting. So let's use a dollar example, if you will.
Yeah.
Somebody puts 10 grand a year in to this whole life policy.
Mm-hmm.
Of the $10,000 first couple of years, there might be 20% of it, right, gets eaten up by costs.
Mm-hmm.
But let's call it 8,000, another 8,000. Then after that, it ends up being about break even. Maybe you get your $10,000 worth, and it's essentially face value from then on, right? So over the course of 10 years, you put in $100,000 and you have about $95,000 ish to show for it. Is that what you're saying? Not including the growth of it, right? So that's just the principal contributions and the principal value. Now each year it also grows at 5 to 8% or whatever it ends up being on an annual basis. So the balance is growing and compounding on an annual basis. There's a floor, but there's also a ceiling, correct?
Correct. Well, no, there's not on whole life insurance. That's true with universal life. That does not happen with whole life. Whole life pays dividends and it's very just stable, right? For example,
so is it like a fixed dividend return, or is it like, could you lose principal value on it?
You cannot lose principal. That only with whole life. Universal life, you can lose principal, not with whole life. That's the difference, right? So whole life has a minimum guarantee of at least 3 or 4%, depending on the company and whatnot. So that's if they pay what's called a no dividend scenario, right? I use insurance companies that have been paying dividends for over 175 years straight. So pre-Civil War, pre-Depression, and during the Depression, I mean, they would always pay more than their minimum above and beyond that. So that's why, like, for example, one company, they've been paying somewhere between 5.75 and 6.34 for the last 20 years straight. So it doesn't really range a whole lot.
So predictable 6%. So it's better than a CD. It's better than a money market. It's better than putting your money in bonds. It's slightly better than all of those.
Even better than treasuries.
But I do like the tax advantages of it, right? Not being taxable, and the security against creditors. That's a big deal as well.
Yep, exactly.
And then what you're saying is 10 years from now, there's $120,000, $140,000, $150,000, whatever it's grown to. You can get about 95% of that, take it out as a loan. When you take it out as a loan, let's assume it goes from the insurance company. They're charging you the same 6% on whatever money you take out as the 6% that they're paying you, roughly, that's on the balance that's in there. So if you got 150 grand and you take out 135, you're paying 6% on 135, but you have your $135,000, and then there's still they're paying you 6% on $150,000. So there's a little bit of a spread there. The benefit is what you're saying is I could take the 135, go and buy a single family house that kicks off, $1,000 a month or $800 a month in positive cash flow, use that to then pay down the principal loan balance. The property's appreciating in value. And at the same time, you're paying down the loan that's against your life insurance. And so that spread continues to accelerate over time.
Right. Exactly. The spread gets bigger and bigger and bigger. So give you an example. I show this a lot on my YouTube channel on Money Ripples there, but I use an example, like someone wants to put, say, a $250,000 down payment on $1 million multifamily, right? Like small multifamily, obviously. That $250,000, if you just use your savings account to do that, say the savings account's paying you 0.1%, like my bank would lower to 0.05, but let's say it's 0.1, over 9 years, say that cash flow $2,500 a month, that 1% a month, which would be awesome to get nowadays. That $2,500 a month going into your savings account, after you pay taxes, you make about $1,200 over 9 years, right, in interest. So it's not anything sexy because you just drained your account and you're just rebuilding it. So that compounding interest sucks. But when I use my life insurance, because that $250,000 is still there, and then I use the cash flow of $2,500 pay back to the line of credit instead with the insurance company, what ends up happening is over that same 9-year period of time, I net, even though there's insurance costs, even though there's interest being charged, I still net $126,000 in my situation when I was in my mid 40s. So if you're younger, it could be better. You're older, it could be a little bit worse. But either way, it's still better than $1,200, right?
Is there a limit on when the premiums stop needing to be paid? Right. So like if I'm putting 10,000 a year in, is that for 20 years? Is that for 30 years? Is that for 11 years? Like, is there a time that it stops where you have to, where you can stop making contributions to the premium?
Based on how we design them, you can make it just about whatever you want. The minimum number of years you have to pay into it is 7 years, and that's it. You can let it ride forever. Technically, I actually showed a guy who wanted to put in 100 grand a year for just 4 years and then borrow from the cash the next 3 years to pay in. And even after that point, he still had $420,000 at the seventh year. So even though he wasn't paying into it and there's still interest charging to him, he still made more, right? So, and then he would want to just be done at that point. So you can pay it for 7 years. You can pay it for 40, 50 years if you wanted to, and you can make the end date, whatever it is. Here's the key thing.
So if I have $100,000 in an account and I can take out 95 grand, can I put that 95 grand back into the account and it looks like I have $195,000? My loan is only 95,000 against it.
As long as you don't go over whatever the max contribution limit is that year.
Okay, so there is a max contribution.
There is, yes. So the way we do it, and this is how it's different with us than some of the other companies, but the way we do it is that we always put a max limit. We set whatever that's going to be. By the way, that max limit can be up to 25% of your stated gross annual income. So I had a friend he's a syndicator, right? Obviously has a lot of apartment buildings, depreciates everything, including his wife's teacher salary. He showed a net profit of 25 grand on his tax return, and with that, he's like, okay, how much can I actually contribute? I was like, well, 25% of your stated gross income. He's like, what if I claim 25,000? I'm like, it doesn't matter. I'm like, the fact is you're a real estate investor. We take away all the depreciation stuff. They're not even going to look at tax returns anyways. We can just say, listen, like, what is it you really gross? He's like, I gross about $1 million a year. Great. We can contribute up to $250,000 a year into this, right? Now his minimum is going to be right in the ballpark of about 50,000 a year. So that means he has to put in at least 50,000 a year. Even if he has to borrow from the cash from the policy, then pay that 50,000, right? If he's got more cash in there. But you can make it as low as 5,000 or 10,000 a year max with a minimum of like 1,000 or 2,000 bucks a year too, right? So it's very flexible. So that's the key, is that you don't want to go over the max. If you do, you trigger taxes. So we try to set that up ahead of time.
What about the life insurance aspect of it? Like, what is the policy value if something ever happened to whoever the borrower is or the contribution maker, like, or I guess not the beneficiary, but whoever's got the life insurance policy on them, right? Let's say it was me. And then something happens to me, I pass away. What is the face value? Like, what is the insurance value? So let's say there's $100,000, $10,000 a year. 10 years later, something happens to me. There's only $100,000. Is the face value, I would assume, is much substantially higher, but then they keep all the premiums that you paid in?
No, they don't. So here's how it works. With whole life, it's a little bit different, right? With whole life, for example, when you're paying that money in, it does grow cash value. Let's just say it's 10,000 a year on you specifically. That might buy, and based on how we design them, we try to do the minimum death benefit needed to allow that maximum amount of cash to go in while keeping it tax-free, right? So we're lowering the cost as low as we can go. So that's 10,000 a year. Let's say it buys you $250,000 of death benefit. But let's say after 10 years, though, it's also growing the cash value. It's also going to grow the death benefit too. You might see that death benefit grow up to like $350,000 or $400,000 by that 10th year. And then that will pay to your family tax-free. They don't take out the premiums. The only thing they would take out is if, let's just say that over those 10 years, if you're paying $10,000 a year, you'll probably have like $140,000 plus, $150,000 in there. Say you borrow 100,000 of it, right, to use for whatever, and then you die. Well, if say that death benefit was $400,000, they'll take their 100,000 of loan back to pay off the loan, and then pay the rest, the 300,000, to your family tax-free.
So they'll take the amount that's in there plus whatever the death benefit is minus whatever you borrowed against it.
Yeah, exactly. The death benefit just kind of goes up over time. It's not like based on how much you pay in cash. In fact, early on, you'll probably have a higher death benefit than what you've paid in compared to the original death benefit based on how we do it. So it's kind of a whole little formula. It's easier to show you than it is just to describe it. But yeah, that's basically
it's super interesting. It kind of clears up some of the smoke and opaqueness around the space, and has really, really helped with providing a lot of clarity, man. So I appreciate
Yeah,
doing that. I'd love to sit down and just kind of like understand what it would look like on an individual level. How
for
can
sure.
people connect with you and learn a little bit more about this and potentially look at it for their own situation?
Yeah, easiest thing is you go to moneyripples.com. There's an infinite banking section that you can go to. It even has like a little like webinar that I did on it and everything. And you can even book a call to talk with someone to actually see what real life numbers look like for you.
Awesome, man. Well, hey, I appreciate you being here. I always enjoy our conversations. I love talking dollars and decimals and really getting into the granular side of things, especially for someone who's been trained in traditional financial advising world, but has come to the light side and understands what actually works the best for clients and for real estate investors and for people in their own personal financial situation. So awesome having you, brother. Thank you so much for all your insights. Make sure you guys are connected with Chris on his podcast. Make sure you're connected with him on social media. Go and check out moneyripples.com if infinite banking is something that you're interested in. I don't have an infinite bank, but I'm interested in it, right? I've always kind of utilized Roth IRAs and my depreciation from real estate, some all these other benefits, but I do think this is something that is very, very powerful, especially because of all the different boxes that it checks in the asset protection, asset scaling, leverageability, insurance and protection, and all those different pieces. So good stuff, man. Thank you for shedding light on it.
Yeah, it's been a pleasure. Thanks, Tim.
Awesome, guys. Well, appreciate you being here. Thanks for checking out the Legacy Podcast. We're here every Sunday. Make sure you subscribe so that way you get notified of all future episodes. And we will see you next week on the Legacy Podcast.